Welcome and thank you for joining us for the FinTech Sandbox's FinTech Talks this week. Our session today will be talking about the digitization of everything in financial services with our incredible lineup of speakers. I've prepared some of my own questions to get the conversation started, but we will also be accepting Q&A from the audience. To submit your questions, please put them in the Q&A box on the platform. There's also a chat box. Feel free to jump in there to introduce yourself, comment on the insights that are being shared by the panelists throughout the discussion. Don't put your questions in the chat box, though, because our panelists will not be able to see them. Please use the Q&A box. My name is Andy Beal. I am a blockchain strategy lead at Ernst & Young, and I'm joined by two wonderful panelists today. The first is Anders Brownworth. Anders is a principal architect at the Federal Reserve Bank of Boston, where he leads their applied research efforts with blockchain and digital currencies. Prior to joining the Boston Fed, Anders was the chief evangelist at Circle, one of the leading digital asset wallets and exchanges. Our second panelist is Steve Kokinos. Steve is the CEO of Algorand, one of the leading proof-of-stake blockchain protocols. And prior to Algorand, Steve was the founder and CEO of Fuse, a global unified communications platform, and he remains the chairman. Welcome, Anders and Steve.
Thanks a lot. Appreciate it.
Thanks, Andy. Good to see you, and look forward to the discussion, Anders.
Likewise.
So our topic today is the digitization of everything. And just given our backgrounds, we're obviously going to focus on blockchain's impact on the digitization of financial services. We've got a long and interesting list of topics that we're going to try and hit with the time that we have. We're going to cover blockchain as global financial infrastructure. We're going to talk about programmable money. We're going to talk about DeFi, which is receiving a lot of attention right now. And we're also going to talk about the role of government and what we're seeing out of countries like China with respect to blockchain adoption. But to kick it off, I want to get a little retrospective. Blockchains have been around for a little over 10 years now. And Anders and Steve, I'd love to hear from you, what has your impression been of how far we've come? What's been built over the last decade, and why are you so excited about the future based on what you've seen?
Yeah, well,
we can.
Yeah. Okay. I'll jump right in. I should mention up top that these are my opinions, not the opinions of the Boston Fed or the Federal Reserve System. But that said, what's really intriguing here is there's this possibility to have a digital bearer asset, or essentially an asset that does not require, it can have, but it does not require an intermediary to be moved. That has created this brand new thing as essentially a software primitive that you can use to code, and that's trust. You can actually use that as one of the building blocks. So what's really compelling is, especially as applied to financial technology, is you can rethink the way that all the traditional financial primitives have been built in a decentralized context, rather than having to trust a single centralized entity. For example, you essentially spread your trust so much that you don't really have to trust any one entity at all, and it's unreasonable that trust would be violated. So that's what's new, and I kind of look at if you look at the innovation that's happening in FinTech, it seems to me evolutionary. It's building better, faster, more interesting, more useful kind of constructs on top of existing technology. And then you have, from the other side of the fence, you have this really sort of disruptive way of thinking about things, which is very revolutionary. It's like, well, how do we rebuild from scratch if we have this brand new thing that blockchains allow us called trust? What can we do with that as a programmer? So that's what's compelling. Obviously, I'm leaving lots out, but there are many things that have happened in the last 10 years. But it's been only 10 years and kind of feels like a lifetime, frankly. There's a lot that's gone on. So I'll leave it there.
I think just, to jump in on that, I think in a lot of ways, the 10 years have sort of got us to the start line. And I think one of the ways to really think about it is if you look at the ways the world has changed over, let's take the past 20 years with the internet. I think it was difficult to imagine when everyone was using dial-up modems and it took 5 minutes for a banner ad to load, the people will be watching TV in the back of their car on a cell phone as they drove around. So I think, it really requires sort of these initial innovations and sort of these new ideas of primitives. I agree, Anders. I think establishing trust between people that really would have no other way of trusting each other, establishing algorithmic trust, I think is a real innovation for the world. And I think more than that, though, if you look at from a commerce standpoint, the way the world has changed, so much more global commerce is cross-border, people manufacturing thing in one country and sending it to another. And there are so many problems that businesses have that can't really be adequately handled either from a financial or legal frameworks that exist today. So I think in terms of where we are, there's so many fascinating possibilities, but we're really getting to a place where the technology can solve problems because whether it's people in different countries or people who simply don't know each other, trust is this fundamental thing that people need in order to be able to exchange value. And I think really the user experiences of how people exchange assets, think about if you buy a car or a house or something else, it's very antiquated compared to the ways we do so many other things. And so I think really where we are is at the beginning of this reimagining of how all sorts of different financial transactions happen in a way that will benefit users, really anywhere in the world and drive, much better user experiences that effectively are the same sort of low friction, friendly way of doing of transacting that we see in virtually every other aspect of our lives.
Thanks, Steve. I want to highlight something that Anders said because I think it deserves an underline, and it's that FinTech innovation has typically innovated from the top down, where you have companies building a better customer experience, for example, right? But they're sitting on top of a very old, very sort of traditional financial infrastructure, right? And Anders talked about this sort of idea of building something from scratch, right? Building it not from the top down, but from the bottom up. And the difference between where the top-down innovation is happening and where the bottom-up innovation happening on blockchain is that blockchain bottom-up innovation is happening natively on top of the internet, which I think is absolutely fascinating. And over the last 10 years, you've had this infrastructure that is now multi-layered emerge, and it is by nature public. And this lends itself to, entrepreneurial opportunity that I don't think we've really seen before. And Steve, Anders, both of you touched on this idea of, a toolbox or this idea of primitives. And how do you think about, the power dynamic shifting maybe from finance to the tech industry, because now all of a sudden we have this growing toolbox of financial primitives, token standards, public accounting systems in blockchains that allow anyone with a computer science background to start building brand new financial products and services from scratch.
Yeah, well, so what's new here, from a software development perspective, in my opinion, is, back in the day, you might write some open software code, you put it on GitHub, people download it and use it, and kind of the worst thing that happens is it crashes or something like that. There was if you were collecting personally identifiable information, there was a little concern about that. But beyond that, it wasn't really all that dangerous. And now you have this possibility that you could lose people material wealth if with a coding error, with a bug, which certainly has happened, and then that's different. So you have all these technical people, like the technical industry, coming at this and saying, hey, this is great, we can do all these things, and suddenly there are issues, and society comes to them and says, hey, wait a second, we got to have some recourse here. There's some issues. On the other side, you have the sort of the traditional industry, realizing that there's all these brand new things that can be done, and people are doing some pretty wild stuff, especially in the DeFi space, and playing around with token economics and incentives, and it's very fascinating. But they're looking at that as like a totally different, from a totally different mindset, really. So you kind of have two worlds colliding and clashing, and you're sort of seeing the fireworks happen in the DeFi space, especially. Yeah, that's been it. I don't know if I've answered your question, but that's been sort of interesting from a software developer's perspective.
Yeah, I think at Algorand we've thought about it in a similar way, but maybe a little bit differently. I think one of the things we observed, I think, is, like, to your point, Anders, is if you make mistakes, people lose money in this world, which I think is very different than a lot of web or mobile development or mobile developers are used to. I think also when you look at core platforms, one of the things we've really focused on is what are people using blockchain platforms for? What types of assets are they looking to issue? What type of products are they looking to create? And when we think about primitives at Algorand, we focused on a series of layer one features that enable people to issue currencies, issue different types of token securities, but also govern the way they transact. And there's a fine line between having enough flexibility and having too much. And I think we've tried to really bring people the set of tools that they need, but do it in a way that doesn't expose them to some of those same security problems that happen elsewhere. And I think also the other is, you need to be able to do these things with speed and scale and still maintain security. So I think they're all very intertwined, but definitely this idea of primitives, we think, needs to go beyond the consensus layer where people use blockchains to agree that something has happened, and move into some additional functionality where they're still getting the protection of the underlying protocol, and not being able to make too many decisions that might lead to money loss.
And that's definitely a topic I want to get into, especially when we talk about DeFi. I'm monitoring the chat box, and I'm seeing a few questions. I've jotted down a couple, but one of the themes from the audience is at what point does blockchain become visible to the consumer? And so I want to take this as a discussion thread, and I think, for the folks tuning in, I think it's important to acknowledge that this is infrastructure, and so if you, by analogy, if you think about your experience surfing the web, right, you're looking at a browser, but behind that browser is a technical stack of protocols that is serving up that information on your screen. Similarly, blockchains, are the equivalent of that, but for finance natively on the internet, right? And it's essentially the accounting system for the web. And so just like you aren't likely to interact with your bank's internal accounting system, you aren't likely to interact with the internet's accounting system as an end user either. But Anders and Steve, I would love to hear your opinion on sort of the relationship between the end user and the underlying protocols, Steve, especially from you, because that's Algorand's core business.
Yeah, I can. Why don't I take a first crack at it, and then Anders, you can keep me honest. I think when we look at what a sort of foundational protocol needs to be, it's really a public utility. And I think, it may seem difficult to think about it this way right now, but a while back, it would have been hard to think about it the way we do, which is, if you think about what you have at home, you have water and electricity and an internet, and probably internet's more important than, the water. So I think that, blockchains, public blockchains, and public permissionless ones in particular, we think really will ultimately become public utilities. And I guess the simple way to think about where that intersects from kind of an infrastructure standpoint in a relatable way is, I'll just go back to Netflix again. When you fire up Netflix, they're using Amazon Web Services behind the scene, and Amazon Web Services is very valuable to, utility for many different companies. But it's not the case that you see an Amazon Web Services logo when you fire up Netflix. That doesn't diminish its value. And so I think when we look at a platform like Algorand, that's really what we want to see. We want to see digital money launching on top of it, people issuing assets, building really interesting applications that bring utility to the world. And we want to be a trusted platform that people use. Now, I think in terms of visibility to end users, certainly as people start to transact using digital money instead of physical money more and more, I think that's an obvious touch point for end users. And so I don't think it's just the case necessarily that the underlying platforms, will always be unknown in the same way that, kind of a lot of the internet stack that's used isn't very familiar to end users. But where that line is, I think remains to be seen as the market shakes out.
Yeah, back in the day, you used to only be able to text the people that were on your cellular network. In order to make a call to someone on the other side of the planet, you had to pay long distance. First of all, you had to have like a plan, and then you had to pay these fees and, permit fees and such and such. However, really at the same time, you could send a packet to the other side of the world for no additional cost. There's no marginal cost. Suddenly these protocols show up, and now you can do that. So the difference is, you stop thinking, oh, I'm not going to call that person. Instead, I'm going to, use FaceTime or some web chat protocol of some sort. And now you have this free, obviously better, that sounds better, and you can see them on the other side. It's, and it's also doesn't cost you per minute. So that technology sort of showed itself because of that, because of the new capability. You could you had a data channel, you could send anything through it. So looking at blockchain technology in general, I don't think for the most part, like you say, Andy, nobody's really going to, kind of see it directly, but they will see the capability, the new capabilities that it allows. And one of the places I think that will appear is in people having really to understand what a digital bearer asset is if they want to take advantage of that. Like, you'll have the ability to actually hold your own assets rather than having to trust a third party. I think, beyond that, you can think about, programmable money. Money is programmable in a sense. You could do that with an API sort of through the traditional means. But now that programmability is guaranteed from the root, and if it is set in the chain, it's essentially set in stone. You can always trust that will happen. So I think ultimately people will start to use protocols sort of that have been built upon blockchain technology that gives them new guarantees, and they'll become more aware of sort of the new capabilities that this technology presents. But now you're not going to, one of the really cool things about Algorand, Steve, is that it's like a total rethink about how that base layer could work from a computer science, cryptography perspective, really. And so there are many ways that you can actually implement this. There's sort of the Bitcoins of the world and Ethereum and a bunch of other chains kind of trying to compete on speed and capabilities, et cetera. And it also points to the fact that this is very young. However, across all of them, I would argue, they're really just creating this new primitive that I call trust that you can now use as a software building block, and that's what people will realize is new. Yeah.
So one theme I picked up on from both of you already is that this idea of programmable financial assets, and that takes us to the next topic I want to touch on, which is money. And in the spirit of this chat, which is focused on the digitization of financial services, I want to acknowledge kind of where we're at today from a digital standpoint and where we think things are going. So, Anders, this first question is for you, just given your relationship with the Fed. I think there's this there may be a misconception about money being a purely sort of physical thing, when in reality, there is a significant amount of money that is actually issued in exclusively digital form, right?
Mm-hmm. Yeah, exactly. The history of money is very fascinating. We don't need to get into that, but yeah, you're right. So the Fed essentially that has two different liabilities. One is cash. You have $1 in your pocket and this is a Federal Reserve note. That's a liability against the central bank. And then the other one is this concept of really commercial bank money. So it's really just digits in a database, and that, in my opinion, satisfies the definition of what is digital money. So yeah, we've had digital money for a long time. We've been able to zap money around the world relatively quickly for a while. Granted, it's using intermediaries and whatnot. So it's like it's not like it can't be overhauled. It can be fixed or really improved upon. But we have had digital money for a very long time, ever since banking records have been computerized, and probably even before then, if you think about it. Using a telephone to settle accounts, it's sort of the same. But yeah. So.
And thank you for that. Thank you for that foundation, because I want to build on that. So what's the difference between the digital money that you just described and the digital money that is emerging on top of public blockchains?
Yeah, that's a great question, and really it just really unfortunately comes down to definitions, I would argue. Some of these things are it's very difficult to say, well, what actually is a cryptocurrency or a digital currency or digital money? Like the definitions there are not, broadly understood, right? So what's new, in my opinion, is this ability to have a digital bearer asset. Like a dollar bill is a bearer asset, right? You have the dollar bill, I give it to you, I no longer have it, you have it. We independently, do that transaction. We don't require a third party to do that transaction. And now we have moved money between ourselves. And, hopefully no new money was created. I have lost the money that I have, given it to you. Pretty clear, right? We understand this primitive because it sort of works in the physical world. Same thing happens with any other physical object, so that works. Same would happen with gold, for example. However, in the new context now, we've got this ability to actually not really sending a token of a cryptocurrency to somebody, you're really just assigning the ability to spend it to somebody else. But it's a technical, detail, really. Ultimately, I can give you money without requiring a single centralized party to do that clearing. So that's new. And if you think about it, it's always why I keep coming back to trust, because that's really what's new here. You don't have to trust a single centralized institution. So then there's a whole bunch of things you can do with that. Now that I've moved this money to you, I could move it with conditions, or I could attach different things to it, and that's actually quite exciting, and for the most part unexplored, I would argue. So it's a digital bearer asset with some new capabilities that we haven't fully explored yet, I would argue.
I'd probably, just to add on to that, I think there's probably maybe a couple of other things to think about. So adding to what you said, Anders, I think one of the differences is, for sure, physical money is a bearer asset. And if I can hand you $1 and you have it and I don't have it, the digital part of money today is not structured that way. It's very much reliant on a hierarchical system where the central bank issues money to large banks, and they then distribute it out to their customers, and it goes through several chains. And really, the trust comes from the regulatory framework that exists sort of around all of that. So I think one change is that now you're moving kind of the same peer-to-peer exchange that you have with physical money into the digital domain. And I think certainly that opens a whole range of possibilities. The second thing, though, is I think that these centralized systems are great in countries like the US, but there's a lot of places that don't have nearly the level of sophistication or infrastructure that we have. And I think a secondary benefit from blockchain-based systems is that now you can bring the same sort of level of financial sophistication to people and to countries that don't necessarily have that internally. And so I think that's another real benefit around financial inclusion and around really kind of improving the way that people can interact and do business, not just in countries that are developed and have that infrastructure, but also to people who live in places that don't necessarily have that.
I think this is a great time to introduce stablecoins. Ander, you had a hand in launching USDC, and Steve, Algorand now supports USDC. I would love to hear from both of you sort of what you think the business case is for stablecoins going forward, and how you just think about the concept of money almost becoming a product that, frankly, tech companies can compete with each other on.
Yeah, so real quickly, a stablecoin is a token that represents a dollar. So a token that runs on a blockchain that represents a dollar. So what's new, though? Well, what's the use case? Well, initially, it was really just for traders to have a flight to safety. They wanted to be able to get out of something that they felt was falling or something like that. And also for those same traders to move large amounts of value, to the other side of the world at 2 o'clock in the morning on Sunday morning, maybe when banks aren't open. That was kind of the early use case. But to get to where it might go, I would argue really want to look at what's happening in the DeFi ecosystem. It stands to reason that if you were going to, be let's just say making a loan on a DeFi platform, that you wouldn't also want to take the risk of holding whatever the underlying assets are. It's nice to be able to not have that value fluctuation happening. So there's some new, kind of use cases for it. Yeah, that's what I would say.
Steve, anything to add there?
Yeah. So I think that if you start to look at the types of assets that people may want to deploy, I think you can really look at blockchain platforms not only as a place where people are issuing currencies and stable coins and things like that, but also they're tokenizing physical assets like buildings or artwork or any host of different financial products. And those ultimately need to be exchanged. And I think definitely having sort of durable exchanges of value is important. I think the U.S. dollar is the most widely used currency in the world, so having U.S. dollar tokenized assets on chain, makes sense. And I think as people start to construct that more, they're going to want diversity of assets. I think, if you take the bearer asset idea further, now you can have digital representations of stocks and bonds and, all sorts of property. And I think what we see, especially in younger people, is there's a desire to directly hold assets versus have this layer of intermediaries and fund managers and other things that have sort of existed in the financial community for a long time. And so I think as people seek to sort of assemble their own basket of assets that they think are going to be valuable to them, I think that's where stablecoins play, certainly a very good role, because you need a way to move between different types of assets and different financial products. And I think as we, start to see more and more invention, especially around DeFi, definitely I think there needs to be a unit of measure for, a basic unit of measure for any of these products.
So is it safe to say that in the absence of a government issued fiat currency existing on large public blockchains, that we're likely to continue to see the growth of these privately issued stablecoins?
Well, I think there's certainly an upside. I think there's a great case that privately issued stablecoins will be durable. I also think we'll start to see other forms of stablecoins exist in the market. The Marshall Islands recently announced they're going to be launching their national currency on Algorand. So that's a central bank digital currency, one of the first. I think we also see.
Congratulations.
Yeah, thanks. I think it's an interesting use case, and we hope to see more countries taking advantage of the platform. At the same time, I think banks may likely issue their own stablecoins in certain instances. And I think if you look at the news that came out this week that nationally chartered banks can, or last week, I think, can now, custody crypto assets. I think we're going to start to see a little bit of a blurring of the lines. And so I don't think it's necessarily the case that there'll, only be one unit or one type of stablecoin. I think this is what we're starting to see is there are different ways that people can approach the problem. And I think we'll start to see, a bigger variety of assets. I certainly think that, as stablecoins like USDC have a big lead out in the market and, are doing very well as a result of it. And I think that there is definitely a case where, we may start to see more retail usage and others. I think that's why we're excited to, see an asset like USDC on Algorand, because we think that that's, definitely can start to enable, payment systems and retail use cases that, haven't really existed in crypto, I think, for lack of kind of scale and speed. Or scale and options that are quick enough to really replace traditional payment methods. So we'll see where it shakes out. But I think largely, there's a DeFi community, there's the traditional banking community that's starting to lean into crypto, and now we're seeing the emergence of central bank digital currencies. And I think all of those could have properties that sometimes look like fiat currency and sometimes look more like stable coins.
Absolutely. So. Both of you mentioned DeFi a few times now, so I want to spend a few minutes on that. But before I do, I kind of want to recap how we got to decentralized finance and the two topics that we've touched on so far, sort of blockchain as an infrastructure layer, and also this concept of sort of truly digital bearer-based money. I think are both key layers, that key sort of technological infrastructure that enable DeFi. So, if you think about blockchain as sort of the ledger system for the internet, it's the foundation, right? The lowest level of the stack, and then above that we have token standards. We have standard ways of representing assets now. And DeFi is this sort of third layer that has emerged over the last 3 years since 2017, and you're seeing I'll create my own word here, sort of the primitivization of not just simple financial instruments like money, but the most common financial arrangements and products. And so, Steve, Anders, I guess what I would like to, the question I would like to pose to both of you is, how do you describe DeFi when people ask you?
That's a tough one, but I'll give it a shot. Had you asked me about this last year, I would have said, hey, look to DeFi, because what they're doing is they're taking the financial primitives upon which Wall Street operates, and they are re-implementing them in a decentralized context, without requiring a centralized actor. However, you asked me this now, and I have to say that it's quite significantly more than that. There are experiments being done in the way tokens are distributed, the way governance is done, really sort of just token economics, or just economics really in general. So it's a mix of what you're talking about, Andy, as the building blocks, but also taking those building blocks already and building upon them, and literally taking projects and forking them and adding a governance token and doing some crazy yield farming type of a strategy to to really just do governance, like to distribute a governance token. And people have no idea how to value this, right? So the prices are all over the place. There's a ton of volatility. It's very interesting to watch. So you have pieces that sort of resemble a traditional system, and then you have these brand new experiments that are really quite compelling, but exceedingly young and mostly meme-based at this point.
Steve, I know Algorand.
Sorry, go ahead.
I know Algorand. I was going to tee you up real quick. So I know Algorand released some new smart contract functionality recently, and I think that was in part to be able to support a lot of these new DeFi applications. So I'd love to hear from you. One about what Algorand did to support a lot of these new applications, but also why you and the team are so excited about it.
Yeah. So if you look, I'll just take 2 seconds to explain what we have. So in addition to being a consensus protocol, Algorand provides in layer 1, so at the primitives level or infrastructure level, the ability to do several things. One is issue assets, fungible, non-fungible, a variety of things. Second is atomically transfer those assets either one-on-one or multi-asset, multi-party in a single transaction. And then we have a layer 1 smart contract system, which allows you to have both stateless, i.e., runs a single time, or stateful, where you can maintain state over a long period of smart contracts. And the idea behind that really is, now we have a flexible way of setting conditions, determining when things should change hands, and how different transactions should be treated. And it's a very flexible system, though designed expressly to not be Turing complete, because what we see is when you have Turing complete systems, security is a big problem. Every smart contract needs to be formally verified if you want to be relatively certain of security. And there's just questions around determinism and exactly what's going to happen in those programs. And so by providing some limits, we also enable certainty on what's going to happen on the blockchain. It also means that our smart contracts, from whether it's DeFi or programmable money standpoint, run at the same speed as a simple transaction. So there is no performance penalty or cost penalty for running a smart contract, which is different on Algorand than elsewhere. The idea behind our most recent release, which introduced stateful smart contracts, was that that was a real requirement for a lot of DeFi applications and experiments. But we wanted to enable a platform that gave people the flexibility to build ways of exchanging and sort of novel financial instruments, but do it in a way that didn't expose them to the same security problems or cost and performance penalties that we see existing in other places. And so that's really what our focus has been, is providing that framework, but doing it in a way that eliminates some of the drawbacks that exist elsewhere. And, so far, I think we've seen, really positive reaction in terms of the types of things that we're creating. And I think what's, fascinating about just DeFi, to go back to the original question, is, it tags on to some of the things that Anders mentioned, but, you really think about the idea of financial products, but now it's, really becoming more than that, where people are looking at, well, how do I govern the way, financial products works in a decentralized way with members of the community, and how do you create incentives to get people to do that in a rational way? And I think that's a lot of what's going on right now. So it's I would say, a ground up rethink of the way not only that you construct financial products and use decentralized systems, but how do you even how do you set rates? How do you determine the way, different mechanisms work, and really handing the keys over to that, to the people who are using it. Now, I think on the flip side, there's a little bit of a downside problem there, which people are also starting to see, which is it's a little bit like going into a casino and not knowing where the house is or who the house is. So it can be a little bit tricky, and I think there's some risks there. But yeah, definitely, I think it's fascinating to watch.
So one thing I heard from both of you, is that DeFi is and to steal a term from the DeFi community, there's this sort of growing toolbox of Legos that you can piece together and stack however you want to construct new financial products and services. And we're building this from the ground up. There are some amazing benefits, to this. Speed and transparency are obviously some of them. But building something from the ground up also means, having to sort of slog through a lot of the R&D that the traditional financial industry has done over the course of centuries, right? And so I'm curious what both of you see as some of the biggest challenges or sort of gaps in DeFi right now, right? I mean, you clearly have this sort of minimum viable financial system on top of public blockchains now, but there are, at least as a user, from my standpoint, there are some glaring gaps, and I would love to know sort of what you think are some of the biggest gaps, and this obviously presents opportunities to entrepreneurs that are listening. Maybe they can build some companies and projects to fill these gaps.
Well, I would say to that just like we've seen with software developers entering the financial space, and suddenly there's this responsibility to the society that they maybe didn't really realize that they had. There's also an understanding of systemic risk and then systemic risk that our friends in the sort of the financial sector understand very well. And there sort of has to be this meeting in the mind. So you ask, what are some of the risks? Well, if you didn't realize that you could take a flash loan, essentially a loan that you take out and repay in the same transaction of an extremely large size, you can do things that, were not originally thought of, prior to, building all of these things. So as some pieces arrive that allow you to massively rehypothecate or do things that were unexpected, like flash loans, that can cause, very disastrous ripple effects. And so, I don't really think we've seen a major, destruction yet. We've seen some fireworks, but as you watch the space, I would imagine that there's some sort of structural, systemic, pieces that we haven't quite seen, because at the end of the day, the people using the system have to be confident with the programming that's been done, regardless of whether or not it was intended, if somebody happens to have, created a bug on purpose or not, you have to really think through all the issues there. And I guess, as Steve said, you hit some very excellent points. Some of those pieces, like you don't want to just go out with a Turing complete language that can spin the whole system, like, crash it down. You want to really understand that before you would do something like that. So it's not just that, but understanding all of the pieces that you've built upon, and how the myriad ways those things could fall apart. Yeah, that's what I would say.
I think, we're coming from, I think it's sort of a very interesting, time, because if you look at the tech world, historically, it's sort of move fast and break things. And if you look at the financial world, it's don't break anything. And I think those two perspectives are sort of on a collision course right now. I think there's definitely going to be opportunity in the market for things to be more codified. Also, I think safety is going to become a priority for people, especially, I think fireworks of money loss that we've seen, we're certainly going to see more along the way, I'm sure. And, even though, at Algorand, we try to think about ways to minimize that, people still have to, write applications. And so I think it's like anything else. There's an opportunity to create the frameworks that people use and can start to rely on more, that will then sort of in turn drive more consistency as people create these new forms of financial products.
I'm going to go to some of the viewer questions, but just a reminder for everybody watching, you can submit your questions in the Q&A box, and they'll be elevated to our team chat, and then I can ask Anders and Steve. One of the questions that came through, and I'm gonna rephrase it slightly. Let's fast forward 10 years, right? And this financial infrastructure that we all agree is sort of this public utility, right, is now even more mature and established on top of the internet now, and we have standards for dozens of different financial products and arrangements. What is the role of a sort of traditional centralized commercial bank in this new sort of internet native financial world? Are they just sitting on top, or have been disrupted?
Well, with the caveat that these are my opinions, not the opinions of the Fed, I would argue that most people don't want to run a node in their house and make sure it's up all the time and it doesn't get corrupted or something like that, and deal with the security, et cetera. And also, I don't think people are really even going to want to be aware of what it takes to store a private key, the power to spend some digital asset. Like, this is really, really hard to do. You got to keep it away from everyone. Nobody could ever see it, and you have to hold it for the rest of your life. Oh, and you also have to have it available at an instant just to be able to sign transactions, et cetera. That's hard to do, really hard to do. So there are plenty of roles for intermediaries there to make it work better, to really just supply user interface on top of things. And there are many, many other roles as well. I think when you look at this, you have to take into account what the players are doing, and what where is the value that they are adding, and make sure that we don't create something that's like very, very disastrous for some player that's in that area. You really have to carefully understand the entire system before you go off and sort of implement something. It's an exceedingly difficult process. But yeah, I think there are very, very few people are going to want to walk around with their entire net worth in their pocket or something like that. Yeah.
I think also there's, if you look at KYC, so know your customer requirements, that's certainly something that banks are very well positioned to do. And I think one other thing that I would just tack on is, largely if you look at the lending protocols and you look at different, products, virtually all of them are collateralized, 100%. And so, it is the case that, banks do a tremendous amount of lending and offer financial products that are not always collateralized and are based on sort of their understanding of credit risk and of kind of the individual people and like what the facts of their situation are. So in addition to sort of the custody and I think user experience things, which there would definitely be desire for, I do think there are also, a lot of cases that, will likely have some algorithmic elements, but are also going to there are going to be reasons why customers need to be known along the way. So I think that, banks are still a good place in areas where relationships do help people get to better financial outcomes.
So is it fair to say then that, over time, blockchain infrastructure and, and in particular, a lot of these DeFi, protocols that are emerging for lending and derivatives and, hedge fund strategies and the like become B2B infrastructure over time, and you have banks and fintechs, and other sort of crypto native companies that are sitting on top, and then, they are providing all of these, services, but also protections and doing it in a compliant way to the users.
Yeah, I think protections are something that's always going to be, it's really relatively unexplored. I mean, Steve brings up the point of, all these loans are 100% collateralized. Many of them are like 150, 200, 250% collateralized. Like they're way over collateralized because the assets are so volatile. So, I mean, to guess at what the future is going to be for those things is as you like really, really hard. I never get it right. But I would argue that there's, there's a slightly different landscape maybe than we have now. Some of the things that you used to trust a centralized entity for drop down into you just get that. And then there are many other, brand new things that never existed before. We probably couldn't even think about, imagine them that will appear. So that's what makes it near impossible.
Yeah, maybe we're all just totally wrong. I mean, somebody can come up with some, new take on these things. And, I think that's what makes, disruptive tech interesting. It's, I agree with you, Anders. That's my best guess is that. But, we may well be proven wrong yet. It'll be interesting to see how it shapes. So we have 2 minutes left. And there's one topic that we haven't touched on yet, which is the role of government. Since we only have 2 minutes, I guess I would love to hear some closing thoughts on what China has announced they're doing with the blockchain service network and their digital currency electronic payment program. Anders, I know, just working for the Fed, I'm sure you have a personal sort of, perspective on this. And then Steve, I know Algorand is one of the public blockchains that is supported by China's blockchain service network, and so would love to hear your thoughts on why that is such an exciting development.
So really quickly, again, my opinion's not the Fed. The progress that's happening over in China is very, very interesting. I'm just personally really interested in how do you build a system that supplies a digital version of cash. Such a thing really does not exist yet. Now, China has a system that is operating, albeit in a small area, but it is super interesting, and they're kind of a multi-tiered approach to it. And, so I look at it with great interest to see sort of how they've solved some of these problems.
Yeah, from our end, I think that China's, focusing on an aggressive timetable around central bank digital currencies and digitizing their own money. I think that's one very interesting thread. I think, frankly, that's caused a variety of other countries to think carefully about, what their central bank digital currency strategy should be, and is, I think really moved that dialogue forward in a lot of ways. As far as the BSN goes, we're really excited to be one of the chains that's selected to be a part of that. We believe, so at Algorand, we introduced a technology recently called co-chains, which allows people to have permission networks that can run separately but still transact with the public permissionless Algorand network. And we think that increasingly over time, that sort of framework is going to become more important. We do think that countries will want to have decentralized networks that run kind of within their borders, and then some will be happy using a decentralized permissionless network that's global. I think that, irrespective of all these things, China's a very large market that has a lot of interest in blockchain technology. There's a tremendous amount of development and new companies being launched there. And so, we're certainly excited to participate in the BSN and see how that evolves. But certainly, I think it seems that, China is on the leading edge of both development and, different use cases for blockchain technology.
Yeah, we will certainly be watching. We are at the bottom of the hour, so I think we will wrap here. I want to thank Anders and Steve for their time. Gentlemen, thank you both for sharing your thoughts with the group today.